From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon, if I may call it that. It's the COB podcast, the COB, and I'm Kyle Rodder. I'm here with Danny Akuye. It's great to have your company on this, perhaps a very interesting day on the financial markets.
Yeah, absolutely. Caught the markets off guard, didn't they?
Yeah.
Bit of reaction we've seen.
Absolutely. 25 basis points from the RBA. I think 1 basis point, if we want to be generous, was baked into the market heading into the decision. But lo and behold, 30 days is apparently long enough to assess the longer variable lags in monetary policy for the RBA. And it's gone bang again. So we've got a cash rate at 3.85%, the highest it's been in over a decade. So really quite remarkable stuff. And I wouldn't be the only one, obviously market participants, but Danny, everyone's left surprised.
Well, clearly the markets were surprised. A lot of the economists didn't think this would happen, but it's, we're back to risk off. Aussie dollar is up over 1%, around 67 cents, and clearly the interest rate sensitive sector's taking an absolute, pounding is probably too strong a word, but nevertheless, some profit taking, REITs off 2%, communication services 1.85%. What have we got? Industrials 1.4, energy 1.5. But look, for what it's worth, my opinion's worth as much as a lot of everybody else sometimes. But I think this could be just a marker of some central banks going, ooh, this inflation could be a little bit stickier. And it'll be really interesting to see the reactions, I think, overnight, and obviously with that Fed meeting coming up as well. And obviously the governor today talking at this dinner tonight, if he's going to be a lot more hawkish in his rhetoric.
Yes, definitely. We'll be watching that very carefully. And you can see there the market, or the CBO 200 closing down by 0.97%. But let's go to those three themes. And it's hard to extricate anything other than just, we'll get to the three themes now. There they are. Rate shock, stocks drop, 4%. The next stop. You might realise, Danny, I did a Bachelor of Arts. Not very well, of course, creative writing major. So I tried to put that to work today. But I think it's very hard to extricate any other story today other than what's happened from the RBA. And it's been that entire response now. And as you alluded to before, with the governor speaking tonight and then the data to come, it's where to next? Could it go higher from here? Because the rates market is pointing to a non-trivial risk that there could be another one.
Yep, indeed. Yep. Okay. We all thought we were home and hosed, but sadly not.
No, absolutely not. We'll have to wait for a little longer anyway. But there were some corporate stories of the day. First, actually wouldn't mind, because I know you were looking at it quite closely. It was Computershare.
Yeah.
With that Macquarie event is actually coming out with some, market moving news, right?
Yeah, lots of companies coming out making announcements, but Computershare basically downgrading their outlook for full year 24, full year 23 seems to be in place. Not so much an interest rate impact on the earnings, but less people using the product basically. And so I think they were off about 5% at one stage. They may have closed down that. So that Macquarie conference really fleshing out what we would call, I suppose, people coming in and sort of saying, oh dear, things aren't quite as good as we thought they were going to be. Not the admission season, what's the word I'm looking for?
Confession season.
Confessions, that's it.
Yes, absolutely. And Qantas News today was the other big story, perhaps announcing a CEO to be, a CEO-elect perhaps, if you want to use a political language, but it's Vanessa Hudson, the current CFO, soon to be CEO, takeover later on in this year. And because of that, we decided to make it the stock of the day. Here is what our guest had to say with Andrew Gagan about the investment case for Qantas.
I generally have a view that if you can leave the post of CEO of Vanilla without going broke during your tenure, you've probably done a pretty good job, because it's a terrible business, generally speaking, with generally awful economics. So if you can escape unscathed, that's almost a win in itself. I have never liked Qantas, so if you own it, you have a different view to me and to start with. But the reality is that these are cyclical businesses generally. I think if you're buying today, you have to have some view of how they're going to go even better in future. I don't know what that future would need to look like to grow profits from this already elevated point. So, no, if I own Qantas shares, I'd sell them today.
Look, I would sell it as well. I probably can't sit here and tell someone who's owned it for a long time to sell everything, but you've had a fantastic run. I think there's a lot of question marks over travel and Qantas specifically. Taking profits here, I think, is a pretty prudent decision for most people.
Okay, so there's a double sell there, and Danny, we were talking about it in the newsroom a little earlier. Airlines, they're hard to love as an investor, right?
Yeah, they have huge capex, and I think Qantas is in the process of really having to upgrade their fleet, so they're going to have a lot of capital expenditure. At some point, people won't be able to travel as much. I've noticed in Australia that domestically, there's huge discounts coming out from a lot of hotels. Apparently, everybody's going overseas, but at some point, even that will tail off. So cyclical business, high capex.
Yeah. Prices look like they're coming down too. I obviously go back to Melbourne fairly frequently. And,
domestically, I think the market's really suffering. The hotel deals out there are just crazy, we've noticed.
Yeah,
recently.
well at the peak I was paying probably 700 return Melbourne to Sydney. It's down to about 300 once again. So that's going to have an impact on margins eventually, or profits eventually I should say. But maybe we'll start on that note because we've got Martin Crabb from Shaw and Partners with us. Martin, we'll get to the news of the day, but we may as well throw your hat in the ring. Qantas, have you ever been interested in it? Have you ever been a holder of it?
Yeah, we've got it in our core portfolio. It's our recovery trade stock. So we're still seeing, we had helped the management from Hello World in yesterday. The travel agent used to be Thomas Cook. And they're absolutely flying, right? So we were saying off air how people over the age of 55 who don't have a mortgage are loving these higher rates. They don't have the energy bills, they don't have the mortgage bills, they don't have the school fees, they're all done. And now they've got all this disposable income that they built up during COVID that they're having a fine old time spending. And of course, travel's the go-to for people. And as you said, Danny, Paris looks better than Palm Beach, I suppose, for a lot of people. So look, we like Qantas. So if you want to play reopening even more broadly than us coming out of lockdown, but more globally, China coming out of lockdown, etc., it's pretty hard to go past airlines. And without the competitive dynamics that you have in the US market, where you've got 60 airlines all fighting for share, here you've got pretty much 1.5. So yes, yields have come down, but they're flying a lot more planes. They were flying 1 an hour or maybe 2 an hour, Melbourne, Sydney. They're back to 4 an hour now. So they're basically working the fleet a lot harder now. So they're probably, Alan Joyce has timed this absolutely perfectly, hasn't he? He's done an Alan Moss, he's got in at the bottom and got out at the top. And he'll be remembered for creating a lot of value, probably a lot of angst amongst customers too. But, if you look at when he joined Qantas and the problems they were having, and you look at it today, the rude health that it's in today, and you're right on CapEx, they've got to spend $24 billion on new planes, but they can actually do that now. They've actually got the balance sheet to be able to do that and do buybacks, whereas when he took it over, the thing was on its knees. So, kudos to Alan Joyce.
Yeah, but let's move on to this RBA rate hike. Okay, so, the wait and see how the lags took effect suddenly became, well, no, we're going to move. What light do you think has been switched on in the RBA boardroom to create this hike?
A little bit of an insurance policy against, the housing market started to pick up. The labour market's not really loosening up, despite the fact there's a lot of immigration going on. The unemployment's still at a 50-year low. Business confidence is okay. Consumer spending's okay. They're not really seeing the deflationary pressures in the economy that they want to see. And they really had to go on pause last time because of Silicon Valley Bank, right? I think all the central banks probably got on a phone call and said, look, let's just pause. So the Fed paused, they paused, the Bank of Canada paused. We'll see the Fed go tonight. We'll see the Bank of England go again. We'll see the ECB go again because inflation is still too high. They said that in their statement, it's still too high. So you look at measured inflation, yes, it's coming down, but it's still got a 7 handle on it, right? When you really look through it. And that's, they're targeting 2 to 3, they're at 7. They've got to keep hiking rates. They've also got the Fair Work Commission coming out with a minimum wage decision, which also impacts people on awards. So it's only 1.5% of workers are on minimum wage, but about 25% are on awards. So it's significant. And that's not going to be a low number. The government sort of indicated they want to see real wage growth. So if you've got inflation at 7, real wage growth needs to be above 7. Now, I don't think the Fair Work Commission is going to come with 7, but then come with a large number. So you've still got this wage pressure that's sitting in the economy. So I'm not that surprised the Reserve Bank went again today. Now, there's people saying they're going to go to 4.35 or maybe even 4.6, and it's like, I think people are getting a little bit carried away with that. But I think 3.85 did make some sense, whether it was this meeting or the next one. And kudos to those economists that called that. I think there was probably 9 out of 30 in Bloomberg that called it, and almost no market participants. So it did obviously come as a shock. We've got 1% off the market today, but central banks are going back again. It's not, as I said, it's not just the RBA. We'll see the Fed, ECB, everyone except the Bank of Japan will put up rates. Maybe even they will as well.
I guess scrap yield curve control, who knows? But last month I asked whether it was like the equivalent of your mother giving you a sort of a dirty look and don't misbehave or I'll whack you over the head a little harder. Is this, I don't know, maybe even like a Dirty Harry kind of hike? Do you feel lucky? Well, do you? And the warning to the households that don't get too complacent here. Stop carrying on because we're going to keep pushing these things higher if you keep spending. Yeah,
look, that wasn't in the language, and I don't think that'll be in his rhetoric at all. He's not sort of blaming anyone for spending money. It's more about we have a duty, a responsibility to Australians to get this inflation under control because of the corrosive nature of it if you let it out of the bottle. And it's kind of trying to stick to that. They were really hawkish in February when they hiked then, and they surprised everyone how hawkish they were. They then went back the other way and became dovish and paused, and now they're sort of trying to get back hawkish again. I mean, they are in a little bit of disarray. I mean, their forecasting's been diabolical. They've had this review which has poked a few holes in the way they do things and suggested quite a few changes to how they make decisions and the process that they use and the communication around that. So, the RBA is not covering itself in glory. And again, once again, they've ignored the market. The market said, look, just stay on hold because there's enough deflationary pressure there. You don't have to do any more. And they've gone, no, we know better. So, tough job. I wouldn't want it.
No, terrible job.
But we'll just see what Governor Lowe says. But the surprise for me was not just the hike. The hike didn't surprise me. It's they left the door open for more.
Yeah.
So it's like we're not done yet. Which so the futures curve hardly traded today because it was pretty quick. But we'll probably see futures start pushing up again.
And do you think this is going to be the catalyst to get that old sell in May, go away thing happening for the markets with this more hawkish rhetoric coming out of Australia? We may see it out of the Fed. Forget Japan, as you said. But, maybe this is now going to be higher for longer and we really are going to effectively crush the economies.
Yeah, I mean, the sell in May and go away is harks back to a day when people used to go on summer holidays and not trade, right? So that was the reason you sold in May and go away because there was no buyers around. But we're past that now. Maybe a lot of Americans still go on holiday in summer, but I think using the calendar to drive your investment policy is not something I advocate. But there are seasonal factors and we can't ignore them, and the sell in May and go away one is definitely one there. But I think in terms of central banks, I still think they are concerned that there's sticky inflation. They haven't done enough to slow down the economy to get rid of the sticky inflation. And yes, headline numbers are coming down and goods inflation is definitely coming down and global growth is clearly slowing. We're seeing that with all the PMI data, but they're just not seeing it in the underlying inflation data. Until they do, they'll probably just stay hawkish. The risk is that they over tighten. That's the biggest concern. And there's this whole argument to say, look at what happens during pandemics. When you have a pandemic or a war or something like that, the conditions are totally different than if you've got grinding higher inflation like we had in the 70s. It took 10 years in the 1970s to get inflation up to being a problem level. Here it's happened overnight because of the stimulus. So I think central banks need to use a different playbook to fight inflation this time. It will come down by itself. They just have to be patient. And so having central banks pause, hike, pause, cut, pause, hike is probably better than them just deciding that they need to get rates to a certain level as quickly as they can. So I think we've moved into that secondary paradigm where they're being data driven, and I think that's the right thing to do. But clearly they're saying we haven't done our job yet. We haven't got inflation to where we need it to be.
So just the investment implications there, because obviously we've seen equities off. That's going to happen when risk-free rates rise like this today. But I mean, how are you sort of looking to allocate your portfolio potentially? Because you said consumer discretionary could be at risk of an over-tightening situation. Clearly they're just going to be interest rate risks to the market. Even real estate actually came off quite considerably. Everyone's worried about commercial property. What are your thoughts there when it comes to portfolio allocation?
Yeah, so we're sitting in a stagflationary portfolio. So the view is, okay, if growth's going to be slow and inflation's still a risk, let's sit in the stocks with large pricing power, quality growth stocks. So you see CSLs, Amcors, Brambles, Transurban, these sorts of companies that can pass on higher costs. And our view was always, that was great last year, that did really well, but going forward, we might start to see a cyclical recovery. If rates are done and inflation's coming down, we need to get a bit more cyclical here. We need to start looking at residential real estate. We need to start looking at consumer stocks. We're now hitting pause on that. This rate decision here, and probably what we'll get from Governor Lowe tonight, and also from the Fed this week, is that we're not done yet, and there's probably another leg down in earnings, or there's another leg down in sentiment about earnings. We don't need to see the earnings move. We just have to. And you mentioned the Confession Conference that happens every May. We're in day one of that. We've got 2 more days of that, and there's another, 30 or 40 companies to present there, maybe even more than that. Then we've got NAB on Thursday, ANZ Macquarie on Friday, CBA and Westpac Monday, Tuesday next week. So we've got a lot of data on the economy and the animal spirits that go with that. So we're from a portfolio perspective, stay in that defensive growth end of the market. Wait a little bit longer for that cyclical. Like we added James Hardie at Christmas. We just had to add something into the housing market, but we don't own any retail. We think retail's still going to be tough.
Fair enough.
Martin, great insights as always.
Absolutely.
Really appreciate them. Martin Craig from Shaw
here.
and Partners. Thanks for your time. Okay, let's push on and let's just look at what's happening overnight, because we've spoken about it already. We don't have to speak about too much. Was that Governor Lowe speech? I just find it so interesting how he is going to, I suppose, do the acrobatics to explain this, because it seems like a hard sell. The communications haven't been top notch. Yeah,
well, indeed, and I guess everyone will be focusing on what comes out of that dinner. Therefore, has he got his communication better in hand?
Yeah, definitely. At least I'll have something to do tonight. That's exciting. Also, we have the JOLTS job openings, very significant in the United States, because we are heading to the non-farm payrolls print at the end of the week. Let's not forget about that. And there's still the concern that, there just remains too many job openings in America for workers to take them up. So that's tonight. Tomorrow, it's going to be very Kiwi focused actually. We've got some jobs data out of New Zealand, and not to be outdone, RBNZ Governor Orr, who's been a bull before it was, a hawk before it was called.
Absolutely.
Also delivering a speech.
Yep, but it'll be interesting. The other thing is retail sales here in Australia. Really interesting to see how they are progressing, I think.
Especially after today, right? Imagine if it was a significant
Well, they're
drop,
historic, right? But yeah, absolutely, yeah.
Yeah, okay. And well, of course, as always, we're going to have a swathe of fantastic guests, so make sure you tune in then. Leaders and laggards. Start with the leaders, shall we?
Yeah, absolutely.
It might be few and far between, but we'll have a look.
Good old Lake Resources. Back in there.
Yeah, absolutely. Cleanaway up 5.8%. Pinnacle Investment as well.
I think Cleanaway was one of the ones at the Macquarie conference, and I think Pinnacle had their quarterly or their month inflows in there. Yeah, they came through. Telix Pharmaceuticals, I don't know, continues to be a momentum play. Yeah, and interesting, Fletcher Building. Maybe somebody thinks that the RBA governor is going to be a little less hawkish.
Yeah, perhaps so. For someone wrong side of that trade. You actually had a chat with, was it Claude Walker about Telix this afternoon as well? Was that, am I mistaken?
Yeah, absolutely. And it's one of those small biotech pharmaceutical companies that is doing very well. It is generating cash flow, but it's richly priced. So 100 million in revenues, 3.3 billion market cap. So it really is, for a lot of those companies, it's about putting on the runs on the board and not just being a story stock.
Yeah, interesting, and it's always hard to transition from hype to just straight up profits, I suppose. So Telix Pharmaceuticals, they're back on the winners list, up 3%. Let's go to the laggards. Well, this is going to be easy to find. Who are the worst performers?
Computershare, downgrade, yep.
Yep, we already spoke about that. So that's Confession Conference, as we're calling it. It's, I suppose, takes another victim, if you will. So down 5%, Computershare. We did see a lot of weakness coming through the real estate plays. Mirvac,
which hasn't had a lot of love recently. They did upgrade the market, remember, last week, and the market didn't think it was too bad. But I, in the absence of any news, it's probably just because it's got a large housing exposure in particular.
Yeah.
Stockland has been on an absolute tear and has been a cracking performer, so I'm not really surprised to see profit taking there. And clearly the market didn't like those Endeavour results, did they?
No.
So Woolies, Endeavour,
Mm.
Marcus Stroger discussed those earlier on. And market's not convinced that it's possibly is recession-proof or slowdown-proof, since no one's calling a recession at this stage. So, yeah.
Okay, so yeah, as you can see, they're off by 3.55%. And we'll quickly whip through the small caps, which you would imagine has seen a little bit of selling coming through, generally speaking. But 4D Medical remains up there, still a volatile stock, but seems to be garnering some interest.
Yeah, Claude Walker also, we discussed that with him. And again, that really is a total story stock in terms of the technology that they're trying to develop with this 4D imaging of your body as you are breathing. So that in Claude's universe, that is extremely high risk.
Is it? Okay,
Yeah.
Well, with a 22% move, obviously high risk, high rewards. Jervois Global back on there, 10.5%, just there to make me happy, I would imagine. Let's flick over the page and, well, there you go. Nothing that I can pick up there in terms of theme, no names that sort of jump out, but nevertheless, it's a bad day for stocks. So you're going to see a little bit of weakness coming through the volatile small cap end of the market. But, Danny, I think that probably does us for today.
Absolutely.
I think we need to take a big, deep breath, maybe reassess our family finances. I don't know, what about you?
Absolutely. No more clothes, no more
clothes.
shoes.
Yeah, I don't think they sell anything cheaper than home brand, so I think I might just have to start, I don't know, change my diet, eating grass. I don't know what options I've got. But anyway, it has been a big day. Remember, you can catch up on all the views and news on our website and app. Until tomorrow morning, make sure you have a great evening.
Bye.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.